Hi, everyone. Welcome. And if you're on the West Coast like me, enjoying a torrential rainstorm, good morning. If you're somewhere else in the world, good afternoon or good evening or good middle of the night. Thank you for joining us wherever you are. I am Sarah Lacey with Decil Capital, and I am joined today by Martin Tobias. What time is it where you are? I didn't even ask.
Hello.
Are you on the West Coast?
I'm in Spokane at my ranch. Yeah.
Okay, great. So we are going to talk with Martin about his wild roller coaster of a journey in this crazy industry. We are going to get all of the wisdom and cautionary tales straight from the horse's mouth, which I guess is an appropriate metaphor since you're on a ranch. And we'll answer all of your questions. You can just put everything in the Q&A tab there at the bottom of the screen. And we're going to have a very no holds barred hour here, all about how to launch a venture fund. Um, I should say before we get going, we are in the middle of registering for cohort 20. I think we had a meeting yesterday and we are signing, I think we're so far breaking records for the number of applications that we're getting. And I believe October was we saw the biggest fundraising records we've ever seen in our system for people raising capital. So every month on month, the third quarter and going into fourth quarter, we have seen record breaking cohorts. We have seen the people in our system raising record breaking amounts of money. So if anything that you hear in this session makes you think of yourself, inspires you, cohort 20 is going to be the cohort for you. The theme of cohort 20 is AI as your co-founder and your co-pilot in your fund, making everything easier for you. So Domenico will put stuff in the links. Go check everything out. All right. Martin, let's get to you. You were mentioning before we went live that you were very grateful that Adeo posted something on LinkedIn, dredging up your failures and your past. So apparently
Absolutely.
you lost everything on your first investment, and you were like, "Oh, I'm so grateful he didn't mention it was 500 million." So it's like, "Oh, well, we'll just bring that up."
Well, I agree. Thanks for that. Yeah, I mean that wasn't my first investment that I lost 500 million on, but I did take a company public, and it was my share was worth over 500 million. It was the last company to go public in the dot-com boom, and a year and a half later, the stock was down 99% like every other stock, and it was about a $500 million loss. But the first investment, yeah, I mean, I basically my background is I was at Microsoft out of college, and I left Microsoft to start my company, which I took public later. But when I was at Microsoft, I started doing angel investments, and prior to starting my fund, I'd done about 250 angel investments, and I'm an LP in 17 funds, and I had done a bunch of investing. But the first 10 or 20 investments that I invested in as an angel, I lost everything because I didn't know what the fuck I was doing. And I just was a guy with money donking off checks to my friends, and that's not a very good or successful strategy. So I learned how to be. I think I learned how to become a good investor the hard way, and I've invested through all the three major cycles: the dot-com boom, the Great Financial Crisis, and then the recent COVID pandemic. And one of the things that you get investing over a long period of time is to understand there are cycles and booms and busts, and you got to understand where you are in that cycle when you're deploying capital. And on average over time, if you make the right number of bets, you can make the strategy work. But you got to do a lot more investments and see a lot more deals to be successful as an investor than most people think.
Wow, that's a crazy story. And by the way, everyone took lost money in the dot-com bubble, and Adeo himself took a company public for $1 billion and ended up with nothing. So I think he lost double what you did. So let's go
Sure.
back to the beginning. How did you get into this business? What interested you about it? How did you get the money to start investing to begin with?
Well, a lot of people ask me how to get into venture capital, and it's really simple. First, you make a lot of money doing something else, and you meet a bunch of rich friends, and then you start investing because you have extra money and you're bored.
Mhm.
That's the most normal path into venture capital. Um, but in my case, I was at Anderson Consulting in the beginning, and then I was at Microsoft just after the IPO. Um, and it was actually interesting. I made a bunch of money on Microsoft shares, but when I left Microsoft, I was working at Anderson as a consultant to Microsoft, and Microsoft offered me a job. And actually, I didn't take it. I stayed at Anderson for a year and a half after Microsoft originally offered me the job. And unfortunately, I went back one time and figured out how much money I lost by taking the job a year and a half later. And it was
Uh-huh.
$20 million that I could have made if I'd have taken the job sooner. So I encourage everybody who has the opportunity to go to work for a startup from a big company, which is what I was doing at that time, to do it sooner than they think because it'll work out. Um,
Mhm.
but in the most recent iteration of me being a fund manager, that started about 5 years ago when the pandemic started. So I had done investments. I'd been a CEO 3 times, venture funded, taking 2 companies public. I had gone back and forth between being a CEO and an investor. When the pandemic started, the company I was running in LA at the time was in the middle of a financing, doing about $1 million a month. It was a next generation health and fitness company, and the company got shut down by the pandemic. We had to do a PPP loan. Our financing blew up. Everything went to shit. But I fired myself from that company because we couldn't afford my salary. So I'm sitting there saying, okay, what am I going to do in the middle of a pandemic? Do I want to start another company? Do I want to start investing? And I said to myself, I don't know what kind of company I would start in the middle of a pandemic, not knowing where the economy is going. So maybe I'll start investing. And I have about a $2 million a year allocation personally to write angel checks. So I started writing checks. And then a bunch of my friends said, hey, we like what you're investing in. Can we invest with you? And I didn't really at that time want to start a full venture fund. So I started a syndicate on AngelList, and it ended up being one of the largest syndicates on AngelList with 4,000 LPs. And I deployed about $30 million of capital there. And then those LPs said, we want you to start a fund because we don't like to do just deal by deal. And so I started a small fund on AngelList. Um, and then I decided that I wanted to be a fund manager sort of full time. And I met Adeo and Mike and everybody. And this idea of VC Lab being sort of like a YC for venture capitalists, I thought I was a fairly experienced investor, but I had never actually started a venture fund and talked to LPs and done all the compliance and all of those sorts of things. So I joined, and it was a really amazing program. I think I was in cohort 6,
Wow.
and it's definitely a closing program. I think I got my fund closed faster and with a better thesis and better sort of operational excellence and everything by going through the VC Lab program than if I had tried to do it on my own, which obviously I could have with hiring my own lawyers and accountants and stuff like that. I just think it would have taken longer, and I would also have not been part of this community, which has turned out to be the most amazing and valuable part of VC Lab. I'm on WhatsApp groups with a bunch of managers. I've co-invested with 10 or 20 other managers. I've met LPs. I've gone to good events. And especially as a solo VC, being part of a community that gives you leverage, not just on the software, but on LPs and GPs and investments and diligence and all the things you need to do to actually be a VC, has been incredibly helpful to me.
Mhm. That's so good to hear. All right. Often I talk to people like you who are extremely experienced, who didn't necessarily quote unquote need VC lab. And they say that they heard Mike and Adeo tell them one thing that they thought was stupid that they didn't need to do in VC lab, but they did it anyway because it was part of the homework and it turned out to be right. Did you have a moment like that? Something that seemed
Yeah, I
counterintuitive.
hated the thesis exercise.
Uh-huh. Tell
Yeah,
me why.
and most of it was because I was just like, because they're like, explain your differentiation as an investor, and I'm like, I don't know how I do it. I'm just cool. Like, give me money because I'm a cool guy. Like, isn't that enough? And they're like, no. You have to actually analyze. And so, I went through at the time my 250 angel investments, and I really had to go through a process of figuring out where I thought I had an insight and an advantage as an investor. And, I discovered through that sort of, I had invested in everything. I was kind of like an any good deal investor as an angel. Like anybody I met that looked interesting, I'd donk off a check to them. Um, but they were like, that probably isn't going to work as a venture capitalist because it's not a replicatable thesis. Luck is not a replicatable thesis. And so you
Hmm.
have to identify where you think you have an advantage or an insight into the market and unique access to deals and things like that. And so, I identified an area, B2B software. I mean, when I was at Ignition Partners, we were the first money into DocuSign, which was a B2B software investment. And, they made 440 times their money on DocuSign. And I go, well, that's a good one. Let me go try to look for more of those. So I built my thesis around trying to find more DocuSigns and B2B software. And that's what I've been doing for the last 5 years. I've made 75 investments, six unicorns, and they tell me that's a top sort of 1 or 2% track record. And they're like, lean into that specific thing. I didn't really like constraining myself, but it was the right thing to do.
Wow, that's a great example. All right, tell me about this criteria of the hustler and the hacker.
Um, well, you know, I'm a pre-seed only investor. I think some people on the call might say, we're going to invest in A, Bs, and Cs and all these different things. But what you'll learn very quickly is that what you have to underwrite at different stages is very different. And at pre-seed, you're primarily underwriting the founder and the founder or founders and what you think they can do because there's very little numbers. There's not a lot of revenue, there's not a lot of product to look at and everything like that. So what you've got to do in pre-seed is to say, what is the archetype of the kind of founder that you have found to be really successful over time? And I came up with those two archetypes as the ones that turn out to be, the most successful founders. And the hustler, what I found is you need two. You need multiple founders are better than solo founders because typically you need to do four things if in pre-seed. You need to raise money, you need to build a product, you need to sell that product, and you need to operate the company. And sometimes you can find one person that can do all four of those things. That's incredibly rare. That's somebody like Elon Musk,
Mhm.
who can basically do everything. But typically it's two different people. And it's one, a hustler person, which understands how to raise money and sell the product. It's the business focused person, really understands the customer pain point, is good at storytelling, has good, emotional quotient, stuff like that. And then the second person you need is the hacker, is somebody who can actually build shit and has proven that they can build hard shit and that understands the current market trends and what has changed in technology that allows you to unlock building a solution where you couldn't have built the solution 2 or 3 years ago. So those two are definitely the highest probability founder archetypes. Sometimes I'll invest in a solo founder that's one and can sort of hire the other. The best kind of teams that I like in pre-seed are the teams that come with both of those already in the company.
Mhm. And how do you establish if you know someone is good at that? Are you just good at recognizing that? Do you spend a lot
Well,
of time with them? How do you get comfortable with that?
What I like to say is in pre-seed, venture capital is a lot of pattern matching, and this gets into the harder to quantify thing. But basically, I can tell, I've met over 30,000 CEOs. I can tell within 5 minutes if the CEO in front of me is in the top 5% of the CEOs I've ever met in my life. I can just tell. Now, you asked me exactly what that is and how did I mean, it's hard to quantify, but you're listening to how they tell stories, how they are honest about the numbers. Do they understand the numbers of the business? Do they understand the customer problem? How deep do they understand the customer problem? All of those things sort of add up. And basically, if somebody's in the top 5% of people I've ever met, I want to start diligence and understand exactly what they're building and their customers and do all of that sort of things. If they're not in the top 5%, and frankly, you know, yeah, about 90% of the founders I meet are not in that 95% by definition, right? And
Mhm.
so that's the first level of screening for me is I just sort of get a feeling within the first 10 or 15 minutes of a call. Do I think this team, do I get the feeling that this team is one of the top ones I've ever met?
Yeah,
And then
great.
that gives me the permission to go on and try to understand their customer, what they're building, their traction, all the rest of the things.
Awesome. All right. So, as someone who came here in the late 90s as a journalist and has lived through all of those eras where you've made and lost money, I want to hear more about your perspective as an investor through all those boom and bust cycles. Um, because there's always people who come, and we're hearing it again with AI now, and like, oh, this is just like 99, and like this is a bubble. And there's whether or not there are booms and busts, it's like each of these cycles is so different. And so, how, as an investor, do you adjust your game? And there's so many really smart VCs that I hear, and they're like, you got to adjust your game on the field. You've got to pay more when you have to pay more, and you've got to scale your fund up when that's the game on the field. There's other people who say, nope, you've got to stick to your own conviction. There's lots of different schools of thought of how you adjust as a VC in a place like Silicon Valley where, the tidal waves can get so big and crash so hard. I'm curious what you have learned about managing these cycles, having lived through three such extreme boom and bust cycles.
Well, the first thing is to realize that there are cycles and to try to have an opinion of where you're at in the cycle when you're writing checks. And I mean, the most important adage, in venture is that your fund size is your strategy. And for almost everybody on this call, or for me being a small fund, my last fund was 11 million. My next fund's going to be $20 million. I mean, your strategy is basically determined by your fund size. Uh, I um, I cannot, as a $10 million fund, do $5 million at 30 pre seed rounds pre-product because my check size isn't big enough to own enough of that, and my fund size isn't big enough. The people who do those funds, those rounds, and can pay up are the big funds. If you have $1 billion fund and you rate a $5 million check into an incredibly speculative deal, that can be fine because it's literally, a tiny single-digit percent of your fund. Um, and so all those high-priced rounds that you see are getting done are being done by the very large funds who have a fund size which will support taking those risks. And the weird opposite thing, in venture is that it's not a value game. There's no value investing in venture. Every time you write a check, it is a low probability event of working. So you're looking for that outlier every time. And the the problem comes in trying in participating at the wrong stage. So the way I do it with my small fund is I stay valuation disciplined, and I try to look for the opportunities that are outside of the bubble. With a $10 million fund, you cannot participate in those YOLO rounds because you won't. Like I have a friend that he just started a $2 million fund. The first check that he wrote was into a Series B at $125 million valuation. He put a $25,000 check in. I said, "What the fuck are you doing?" Um, he goes, "Well, I think, it's going to go up 10x." I go, "Even if it goes up 10x, it doesn't even return 10% of your fund. You just wasted that check. I would rather you take 10 of those $25,000 checks and give them to much earlier companies at a 5 or $10 million valuation, because those companies have the probability, even if you're wrong, even if that one has less risk because it's $125 million company, it's going to have a lower probability of a multiple. I would rather for the small fund you take more risk. And this is interesting. I don't know, some people might have seen that Roloff mentioned something the other day that one of his mentors said, if you don't have a 40% write-off rate in your fund, you're not taking enough risk. And what a lot of first-time managers make the mistake of doing is trying to do what they consider lower risk deals, like investing next to Andreessen Horowitz or Index or one of the big funds as a small fund. But they're playing a completely different game than you're playing as a small fund, because they have different assets. So don't get caught in that. You need to take your own risks, and you need to take them at the right stage. In my fund in pre-seed, what I do is I stay focused on pre-seed, those deals before the big funds come in, and my job is to find those companies that could get funded by those bigger companies later. For example, I did a $6 million valuation round in a company, two PhDs out of Berkeley that were doing something in generative AI. Anyway, I gave them a check at $6 million. They got into YC. They're raising at 30 now from the big funds, and they're going to be one of these YOLO, go bubble type companies. Um, th- are they going to be successful? I don't know, but I'm happy being an investor at 6 and allowing them to get the markup at 30 rather than me coming in at 30. It's a better, valuation time.
Yeah, I think Mark, that's such an important distinction because there's a lot of conversations that we've had with emerging managers about there's this ability when you're writing small checks that you can get into these oversubscribed rounds because people aren't threatened, and maybe you bring some value that you have some specialized value where a founder wants to let you into these oversubscribed rounds along with these bigger VCs. But there's a point at which the math may not make sense. And it should those be the deals you're chasing?
Yeah, I mean, I don't think for a solo manager they really should be. I would rather I'm actually an LP in that guy's fund who wrote the check at 125 million. And I told him, as your LP, I don't want you to write any more of those fucking checks.
Mhm. Yeah.
I mean, you
Um,
can have some, and I even have that in my fund. I have in my current fund, I have 26 investments. The average entry price is $8 million. And under 10 is basically pre-seed. So I've stayed true to the entry price. Um, but I do have a couple that are paying up for what I think is a good team. And I have about 10% of the fund in flyers that I think, maybe I overpaid. And that's fine. Again, it goes back to portfolio construction and what's your core um, investment strategy versus an outlier. It's okay to do a couple of those. And that's what I told the manager who wrote the check up to 125. It's like, okay, fine, you do one or two of those, that's fine. But 90% of your checks should be, the first, people before they raise any money. The reason I invested in this guy's fund, for example, he's pretty popular on Twitter. and he was DMing with the founder of Cursor as he was initially building the product before he raised any money. And the founder of Cursor asked him to invest before he raised any money from anybody.
Mhm.
And I said, that's the check you should write. You meet the founder
Yeah.
of Cursor before he raises money, give him some fucking money.
Mhm.
Don't
Yeah.
wait until he gets the crazy round from Andreessen and go in alongside Andreessen. If you meet the founder of Cursor before he meets Andreessen, that's when you want to invest.
Well, and it's like this is the thing when you're going to be a solo GP. If you're coming at this from an LP point of view, you're not giving someone money to follow Andreessen. You're giving someone money because they're supposed to have a spidey sense. They're supposed to have a deal
They're
pathway.
supposed to
They're
know
supposed to
what's
have,
coming. Yeah, yeah. And
and
that gets back to your thesis that Mike and Adeo made me do, and you have to kind of figure out what that is, and you have to stay true to that for your LPs because your LPs are investing in you to try to get access to that unique set of companies that you say you can get access to. And if you, one of the biggest mistakes that new VCs make is telling the LPs that you're going to do this kind of deal and then doing different kinds of deals in your fund. And then people are like, what the fuck? You told me you were going to invest in software and then you did a, robotics deal or you did a climate deal or you did a drug discovery deal. And I don't understand what you're doing. Are you just kind of, because I put you in a box of doing this kind of thing. I hired you to do this kind of work and you're doing different work and I don't understand.
yeah, so here's one thing I want to try to understand because you articulated really well how you think about assessing founders. Now, when you're an LP, do you think about are you thinking about VCs in the same way? Because one thing that Adeo talks about when people are coming through VC Lab is you're not pitching LPs the same way you're a founder pitching to raise capital because
Yes.
when you're raising a fund, it's not a product. You don't get to like take money and then go run off and iterate. You're managing someone's money. It's a different thing. So when you're coming into that as an LP, how do you think about that relationship? How do you think about assessing that VC the same way you assess a founder? And what are you looking for in that relationship?
Well, I definitely think of VCs as different because you're investing in their decision, their deal flow and decision making ability to pick between multiple opportunities. So I'm an LP now in 17 funds. I've joined 5 funds in the last year. And what I'm looking for in the new funds right now is I'm looking for people that are going to help me with deal flow for my fund. So I look at VCs very differently, I think, than a lot of LPs. I'm looking to invest in funds that invest earlier than me, that invest in similar categories that might be deal flow for my fund to write checks later. And that's actually because there's an ecosystem of different stage of funds. As an LP in my fund, I've got 5 or 6 GPs in bigger funds than me that invested in my fund because they want to see my deals when they raise a seed or a series A, and they are looking at me as deal flow for their fund. So I'm doing exactly the same thing, investing in sort of angel funds smaller than me. And so what I'm looking for, like with this guy that I joined his fund, what I was looking for is I was like, oh, if you are going to meet the next Cursor CEO before he raises any money, I want you to go find that person. And
Mhm.
then, and that's why I joined his fund, is I got convinced that he had potentially some unique access to very, very early stage AI founders. And then the first deal he did was a Series B, which made me um, confused. Um,
Yeah.
but and I told him that's not why I invested. Um, but the way I look at GPs now is what is your unique deal flow access? For example, I invested in another guy's fund who is the head of corporate development for Brex. And he's a young guy. And in corporate development at Brex, he meets a lot of startups that are going on the Brex platform. So he has crazy deal flow. He meets like every startup in San Francisco. And I'm like, oh, okay, I want to be an LP with a guy who's meeting every, inception stage founder in San Francisco. And out of that soup, he could potentially find some other things. I just joined another fund. This guy started a group, a meetup organization called AI Tinkerers. And it's basically they do once a month meetings in different cities with product managers and people that are just fucking around with AI trying to build something. They may or may not be starting companies, but mostly sort of weekend hacker, this whole hacker um, persona of people building stuff with AI. He's got a community of 45,000 people across the world that are coming to these monthly meetups. I'm like, okay, I'm investing in your fund because out of those 45,000 people, are there going to be 100, potential companies every month created? Probably. Are you going to get first look at them? Probably, because you're the, head of that community. That's a reasonable, unique deal flow pipeline that I would love to get insight into. And so usually the LP or the GP is going to say some unique deal flow, some unique subsegment of startups that they think they have unique access to very early.
So I think this is so interesting for people to hear who are maybe early in their fund journey, because so often that I talk to people and we're in this liquidity crisis and they think what LPs want to hear is I'm going to have a quick markup or
No,
I'm going to have a quick win. And like you are very clearly saying that is not why I'm investing. So like people need to
no.
listen to what their LPs really want.
Well, I mean, there are funds. I mean, I don't know how many unicorns there are now. Like there were 1,500 or something like that, but most of them were marked up in 21 or
Mhm.
20 or 21. And LPs understand that most of those markups are not reality today in 2025. So quick markups are good or can be look good on paper, but LPs are getting markup fatigue because there are markups that are 4 years old and companies haven't raised money and they understand that that's not the real valuation. Um, I think it's better traction. Like for example, in my portfolio, I do track markups, of course, but the more important thing is I track revenue traction. And in my portfolio now, for example, when I invested in the 28 companies that I have, the total revenue that they were doing when I invested was $4 million. This year, the total portfolio will do over $36 million of revenue. And so the revenue has grown by 7x and the markup is zero point 0.8, so it's marked to 1.8. So the markups are less than the revenue traction, which to me tells me that the portfolio is probably fairly valued and probably, in fact, undervalued because revenue is growing faster than valuation. Um, One of the interesting things I know that some LPs do is that they look at markups versus revenue. And in a lot of these crazy YOLO fast raising rounds with quick markups, what you'll see is exactly the opposite. You'll see that valuation is growing faster than revenue. And that's going to be an indicator that it's likely a bubble company that you're in.
Yeah. You mentioned earlier that probably for your next fund, you're going to increase the size of it. And you said that your fund size is your strategy. So does that mean your strategy is changing?
It's changing slightly. So my current fund is a average $250,000 check into a $1 to $2 million round. And what that leads you to is that most of the time you're a co-investor. You're not a lead in a pre-seed. You're co-investing with somebody else who's writing a $500,000 check. So with a $20 million fund, I will increase my check to $500,000. So in my current fund, I have led approximately 10% of the time and co-invested 90% of the time. With a new fund, it'll be probably more like 50-50. leading versus co-investing. And the advantage of that is that when you lead, you have a little more flexibility to set price and terms. Um, and also it's just a math problem. In the current fund, my $250,000 at 8 million buys an average of 2 to 3% of the company. And the 500,000 will buy 7 or 8% of the company. And if you have good deal flow and good picking, you want to own more sooner because if your fund is not going to have reserves for follow-on, you're basically being diluted in every round after that. And so if you start with 8%, maybe you end with 2%. If you start with 3%, maybe you end under 1% at the exit. So it's just a math problem.
Got it. All right. I want to ask you about two more things and then we'll go to some questions from the audience.
Super.
Oh, we have got a lot of questions. All right. So I want to talk to you about this 30 days of living with only essentials and your stoic philosophy in
Oh
your life.
yeah.
In my other job, I own two bookstores and we sell a lot of books on the Stoics. And my father was a philosophy professor.
Oh nice.
So I grew up with philosophy at the dinner table. But tell me about this.
Well, I've gotten really great. I really enjoy the Stoic philosophy, and the main idea in Stoicism is to not pay attention to anything which is outside your control. And the way to manage happiness is to want less and to realize that, you know, your life is great even without all the things your monkey mind tells you you need. And so I just decided last month to do it, and when I did it with my family too, I made my kids do it too for the month, and because one of the things that frustrated me, I don't know about if you have kids, I have a 14-year-old and a 10-year-old daughter, and one of the
I
things
have
that's
a
so frustrating,
14-year-old and a 12-year-old.
yeah, one of the things that's sort of frustrating for us is we go out and, you know, we're at Target or something, and they're all begging, I want this, I want that, I want that little T-shirt, or can we buy Starbucks coffee? And you know, the amount of, I mean, it's not a question of whether I have money to buy those things. It's just seeing that desire all the time. And just ended up being frustrating. So I said, in the month of October, we're going to basically only buy the things that we really need. That we're going to ask this question, do I need it or do I want it? And every
Mm.
time, if the answer is I need it, you can buy it. But if the answer is you want it, but you don't need it, we're not going to buy it. And it was just an exercise to remind yourself how many times in life, what you think you need, you actually really want and don't need. And just sort of bringing that idea up to remember every day. And so we did that for a month, and my kids were kind of frustrated. It's like, but you know, I need a Starbucks, you know, triple latte caramel. And I'm like, really? Do you need it or do you want it? And so anyway, we did that, and I really enjoyed it, and I continue to ask myself that. I don't always say no to the wants now, but it was just a reminder of how privileged we are in the world and how little you really need to be happy. Um,
Did they come to appreciate it at the end, your kids?
Yeah, I think so. I mean, they're glad that it's over and now it's November. So if they, you know, on Saturday morning want to go get Starbucks, they can. But we did change it um, even after that. As a result of that, we said, okay, we're not going to say no. But if it is a want and not a need, um, we'll let you get it, but you have to pay for it yourself.
Mm-hmm.
So we are not going to, I mean, we're going to ask, is it really a want or a need? And if it's a want, it's fine, but you have your own money and you can buy it with your own money. So we are not going to, as parents, subsidize your wants.
Mm-hmm.
We'll
I,
provide your needs, but we won't subsidize your wants.
I'm curious how this is what I wrestle with my kids. They almost never ask for wants that are things, but they ask for wants that are experiences. So it's like if they'll go do something with their friends. And so it's like I feel like that's where I'm always getting like the Apple Cash requests. And I feel like if you're out in the world doing something with your friends, if you're going to a movie or an escape game or whatever, I'm like, well, you're out in the world and you're doing something, I'll pay for that. How do you think about experiences versus the Target shirt or a espresso?
That's interesting. Generally, my kids are both introverts, and so if they do go do things with their friends, I'm happy subsidizing their time
That's
with their friends. So I put that in the okay, I'll subsidize that category. Um, you know, yeah, like an escape game or something like that. But if like my 14-year-old's going to the mall with her friend, I'm like, I'm gonna give you, $20 to buy a Jamba Juice, but if you want to go to Victoria's Secret and buy some new fancy underwear, that's on you.
yeah, yeah. I know. It's like I feel like friendship is like in the Maslow hierarchy. Like
Yeah.
I will support that.
I'll support that too. Yeah, I agree with that. Yeah, she wants to go to the football game to see her boyfriend play. Okay, fine. Here's $20 to buy a soda and a hot dog or whatever.
See, no one knew they were coming for teenage parenting advice.
Okay. Well, we got plenty of that.
All right, last question, then we're going to go to everyone else. Okay, first time fund managers, what is the one thing you wish you had known at the very beginning that would have saved you time or money? If you could genie in a bottle yourself, go back to the first you.
One thing. I wish I'd had a clearer thesis about what my advantage as an investor was sooner. And
Yeah,
VC Lab helped me figure that out.
that's a good
I think
one.
without VC Lab, it'd be hard to figure out how to explain your advantage as an investor to LPs. Um, yeah.
All right, great. We're going to go to some questions from the audience. Someone asked about stoicism, so I already did that one. That's good. Um, let's see. What channels do you use as part of your deal flow? Which ones bring the best deals?
I get about 300 deals a month. Approximately 200 of them are cold from my media. I have a pretty active Twitter following and um, webinars and stuff like that. About 100 of them are referrals from other managers, former employees, things like that. When I look at the signal to noise ratio and the number of checks that I wrote, right, it's exactly inverted. So 2/3 of the checks that I write are to deals that I get from referral, which was a 1/3 source. And 1/3 of the checks that I write are to cold, which was a 2/3 source. So there's definitely a lot more noise in the cold inbound than there is signal. And it just makes sense because if I'm getting referred a deal from another manager who's already committed, that's probably got, it's probably a better deal than somebody
But
who has no
that
investment.
I'm impressed that a third of them come cold because when I first moved to Silicon Valley, people always said, I won't even look at a deal unless it comes through someone.
That's true. And I think that that is an advantage that solo managers can do. That's definitely the case if you're a big multi-stage fund. Andreessen doesn't do any deal that doesn't come referred from some other manager, right? NEA, Index, none of those guys. But they're big fucking funds, and everybody wants them to mark up their deals. As a solo manager, it's different. You've got to find um, those people that maybe are outside the big ecosystems. You got to be looking for something, have a model of the founder that you want, the kind of business that you want, and you got to go search out those people that do not have access, and you've got to bring them in to the VC ecosystem and introduce them and get them going. Yeah, so I mean, I think that's one of the things small and emerging managers can uniquely do is to discover companies that could potentially be funded by the rest of the ecosystem later. Um, It's very important to continue to have that. It's going to be more work for you to screen through that shit because there is a lot of crap.
Yeah.
But you will also find that's where you will likely find the kind of deals at good valuations. Um, that you're not gonna. I mean, it's just goes back to the same thing. If three or five people already agree this is a great deal, it's probably already been priced out, or
Yeah.
you're going to be fighting for access. It's going to be harder. You know, I found this company called Newell. They were only raising $500,000. I committed 250 to the 500, and then I introduced them to my other managers. They raised $1.5 million after after I led the pre-seed because I introduced them to other VCs. I was the first investor, and then very soon thereafter, a bunch of other people invested. And those other people appreciated the fact that I found this company before they did, and that I had already written a check, so it gave them more confidence to write more checks. So I
Mhm.
think that's one of the things that small emerging managers can uniquely do if you're good at picking teams, is to be the first investor.
Yeah. Well, yeah, I mean, it goes back to like, why is someone investing in you? What is going to be your thing that justifies, if you don't have a track record, if you haven't done this before, no one is paying you to follow everybody else. And if you're doing the hard work of filtering all of those things, it's like you're earning your keep. You're earning why everyone bet on you. And
Exactly.
you're also, it's going to pay dividends down the line because that's the deal that you can point to and say, look, I brought you this. Okay. Andrea asks, how do you ensure you're not reinforcing biases in investing when you're pattern matching? Our fund is going to be focusing on investing in women, the type of investor we invest in moving forward. Curious how you don't fall into that trap. Certainly something that's happened in the industry before.
Uh, Certainly. And this is a bit of a hot button issue. I am not one of these DEI type people. On the women or minorities or that sort of thing. I know, 2 or 3 years ago, a lot of people were reporting their statistics of this and that. I in my process, I am completely blind to that to all of those non-financial metrics. Um, I can tell, like I said, in the first 5 minutes if a CEO is one of the top 10. But when I look at the checks that I've written, I actually wrote about 40% of the checks to women founders. But I didn't invest in them because they were women founders. I invested in them because they were in the top 5% of founders that I'd ever met. So,
Mhm.
you know, uh, I think that if your thesis is that there's alpha in women founders, then your bias is going to be towards women, and your fund is going to be measured on if those women that you invest in do perform better than men. That's a reasonable thesis. That's a thesis a lot of LPs will get behind. But again, it's going to be 5 or 7 years at the end of your fund before you know if that fucking thing works, right?
Yeah.
I think that it is a that you should stay true to where you think you can find alpha. And the problem I have with some of these criteria, these DEI criteria, is that many of them um, I have not seen correlated to alpha. At the end of the day, what you're trying to do as a VC is to provide is to get alpha, get a higher return than if you parked your money in the S&P 500. And if you believe you can do that by investing in underrepresented founders or women or whatever, that is a reasonable strategy. Try it. If it works, then bang the drum and tell people this is how I'm producing better returns in the S&P is I have unique access to this subset of founders. I have heard that pitch many times. I have not seen a non-financial metric set of criteria relate to higher alpha than the core venture things like I talked about, like do you understand the customer? Can you build the product? I found those kinds of things relate much more directly to whether a company gets successful than the gender or sexual preference of the founder.
Hmm. Hmm. But I mean, if it turns out 40% of them are women, then I think that probably answers the question of how you know you're not falling into a bias trap.
Yeah, yeah.
All right. So, but that's fascinating. I've certainly seen the same thing as, but I think you have to decide. It's the same with investing in the public markets. If you want to be values first, be values first. If you want to
That's
be,
fine.
it's two different choices.
It's different
Um,
choices.
okay. So beyond relevant investment, background thesis, edge in sourcing, winning, value add, is there anything else GPs can do to differentiate themselves as they're raising LP capital?
Well, there's something I did, and it's unfortunately it's not possible for every GP, but I have a higher GP commit than most GPs. I have a 5% GP commit. I'm the largest LP in the fund, and that made a lot of LPs want to invest in my fund. I know it's not a strategy many GPs can do, um, but when you change it from being a fee generation machine to being more aligned with your LPs, anything you can do to be more aligned with your LPs, the better.
Hmm.
That's certainly one thing.
Hmm. Okay, great. Um, there's a lot of questions about sort of what differentiates seed, what differentiates pre-seed, what means that something is the dog going crazy. Um, what differentiates seed, what differentiates pre-seed, what
Sure.
size, when it's ready for investment.
Yeah.
Should there be revenue yet? Some people say pre-seed, but then they want to see revenue. When do you know something is ready?
So this is one of the perennial questions in VC. And what I say, I mean, I actually published something. You go to my blog and on incisive.vc and look at it's called the stages post or something like that. But I basically break the early stages down into four stages: angel, pre-seed, seed, and A. And what's happened in venture is that we've gotten an explosion of early stages. When I did the DocuSign investment, DocuSign's first used to be in 2020 in 2003 when we did the DocuSign deal. The first round anybody did was a Series A, and DocuSign Series A was 4 on 7. They raised $4 million on a $7 million pre. That was a Series A in 2003. You tell that to people today, they're like, what the fuck are you talking about? Right now, there's four stages prior to Series A. And I'm only talking about B2B software. I think in AI it's different, in robotics it's different, in healthcare it's different. So I think what you got to do if you're investing in something else is to figure out for your category what the different breakpoints are. But let me explain what I believe it is for me in B2B software. Now, it's different for every investor. Some investors are going to define it differently, but here's how I define the stages. I define the angel round as you're raising less than $500,000. You've got a PowerPoint presentation. You've got no code, no customers. You're basically raising money to build an MVP. That's what they call an angel round or friends and family round. The pre-seed round is after you've built an MVP, you've got it in the market for at least 3 months, you've got a couple $1,000s a month of revenue, and what you're trying to do is get it up to $500,000 of ARR. And in the pre-seed, you're raising between $1 to $2 million. And then when you get to $500,000 of ARR, and what those pre-seed investors are doing is underwriting you from basically 50,000 ARR to 500,000 ARR. And then at the seed round, seeds today are $5 to $7 million raised for 25% of the company, but they start when companies get to about $500,000 of ARR. And now Series A's are happening at around $2 million of ARR, and Series A's are 10 to $30 million raised. on a $2 to $3 million ARR number. So in B2B software, it's pretty clear. Prior to the MVP, it's a small $500,000 round. Some people will conflate the angel and the pre-seed and say somebody with an idea get a pre-seed. You see in the press people raising, 10, $50 million seeds with no product or anything. Those are third-time unicorn founders done by Andreessen Horowitz. You are not doing that deal as a solo founder.
Yeah, that's the exception, not the rule.
That's the exception, not the rule. The rule is more typically teams of two or three people will raise under $500,000 from their friends and family, build an MVP. The best companies build MVPs with, replit on the weekend and don't even fucking raise any money. Bootstrap that I saw a company yesterday that was bootstrapped to $800,000 of ARR. Um, I mean, you can do that.
Hmm.
So, but the pre-seed tends to be the first institutional round where real VCs like me get interested, but you're raising $1 to $2 million. Seed firms, if you're $100 million firm, you can't write a $1 million check. You have to write a $2 or $3 million check. So seed firms, if you're over $100 million, they're usually coming into a $5 to $7 million round because they have a check size which is so big they can't do a $1 million round. It's too
Yeah.
small. And that's why there's an opportunity in pre-seed for sub $50 million funds to write these 250, 500, $750,000 checks.
It's just crazy to me how these things inflate. I remember when seed was the tiniest category, that it was just the idea of institutional seed was crazy, that was institutional. And then we had to come up with pre, and now we've got to come up with another name. It's like they all grow up, just like children. All
That's
right,
true.
we are at time. We have 1,000 other questions we didn't get to, so we'll have to have you back. But this was incredible. Thank you so much for this hour of your life. I think this was a need, not a want for our community. And I
Okay.
will say for anyone who was intrigued or inspired, we still have the doors open for cohort 20. It is definitely our biggest application rush we're having. So if you want to get in, I would apply right now. And we will definitely have Mr. Martin Tobias again because we didn't even scratch the surface of these questions. Thank you very much. This was incredible.
All right. Thank you. If you have any more questions, I have an AI bot on my website that you can ask questions to or follow me on Twitter, and I'm happy to answer your DMs.
Amazing. All right. Take care, everyone. Bye
Bye.
bye.